For the first couple centuries of the American economy, wealth was easy to measure. You could walk up and touch it. It was counted in acres of arable land, tons of smelted steel, and miles of freshly laid railroad track. But over the last 50 years, a new type of empire builder emerged. Think of him as Inventor Marcus. He doesn't forge metal or lay bricks. Instead, he turns abstract ideas into fortunes through patents, algorithms, and brand equity. He built an empire from something with no physical mass. It is natural to hear that and feel a bit dismissive. Our brains are historically wired to trust physical collateral. We want assets with actual mass that we can lock inside a bank vault. But holding on to that physical bias is a barrier to understanding modern value creation. Today, the most valuable commodities in the global financial system are invisible. This chart shows the composition of corporate value for the S&P 500. In 1975, the physical stuff, property, plants, and equipment, represented 83% of the total market value of those top companies. Watch what happens as we move through the software and internet booms. By 2025, that ratio inverts. Physical assets drop to just 8%, while intangible assets swell to occupy 92% of the entire index. This inversion creates a problem because our accounting rules are stuck in the 1970s. If a company buys a fleet of trucks, it's recorded as a long-term asset. But if that same company develops a revolutionary algorithm or builds brand equity in-house, accounting rules treat those costs as immediate expenses. Researchers at Morgan Stanley looked at what would happen if we treated a portion of those internal investments as the long-term assets they actually are. The operating margins of the S&P 500 would jump, revealing over $3 trillion in market capitalization that is currently hidden from view. The traditional financial metrics everyday investors rely on are effectively broken. If you are only looking at tangible book value, you are blind to the actual engine driving modern corporate power. To grasp how we monetize the invisible, we can look at a literal example of commodifying empty space. In dense urban centers like Manhattan, selling air is a legally recognized transaction known as air rights. This practice began early in the 20th century. Historic landmarks like Grand Central Terminal sit on incredibly valuable real estate, but are unable to build upward, so they legally detach the empty vertical airspace above their roofs and sell it to adjacent developers. When the 861-foot Trump World Tower was constructed, the developer wanted to guarantee views. To do that, they paid the neighboring Church of the Holy Family $10 million for the right to occupy the empty sky above the church's building. The developer paid for the legal right to exclude others from a defined, invisible space. This is the logic that underpins the entire intellectual property economy. Recognizing that invisible assets yield high margins, many large companies have adopted an asset-light strategy. They divest from depreciating factories and outsource physical operations so they can funnel cash into algorithms, patents, and brand equity. Nike is the dominant footwear company on the planet, yet they own very few manufacturing facilities. By outsourcing the physical shoemaking to third-party partners, Nike avoids the financial drag of factory depreciation and focuses its capital on high-margin design patents and marketing. Coca-Cola has been running a similar playbook for over a century. The parent company manages the intellectual property, the syrup recipe, and the brand. The high-risk physical work of bottling and logistics is pushed onto independent bottlers who absorb the costs of factory maintenance and inflation. This extends beyond consumer brands into hard technology. Qualcomm operates as the invisible toll collector for the entire global telecommunications industry. Qualcomm holds the foundational patents for cellular standards like 5G. Even if a manufacturer uses a competitor's chip, they still pay Qualcomm a licensing fee. They calculate that royalty based on the price of the entire mobile device, rather than just the internal microchip. They get a cut of almost every smartphone sold worldwide. The most profitable corporations generate their billions by avoiding the ownership, depreciation, and physical risk of the products they sell. This shift in asset value dictates the reality of the American labor force. The reliance on intellectual property now permeates every sector, from agriculture to logistics. This data dashboard tracks the scale of the IP economy. These industries contribute $7.8 trillion in value, accounting for 41% of the total U.S. gross domestic product. At the same time, they support 62.5 million jobs. Because these assets scale efficiently, they generate a wage premium. Workers who manage or create intangible assets earn, on average, 60% higher weekly wages than traditional laborers, alongside better healthcare and retirement benefits. However, this wealth is not evenly distributed. Demographic data reveals an underrepresentation of women and minority workers in these sectors, reflecting bottlenecks in access to advanced STEM and legal education. The transition to a knowledge-based economy has permanently split the labor market. The gap between specialized idea generators and standard physical laborers is wide, and it is growing. Surviving this environment requires a shift in strategy. For business owners, the priority is asset-light agility. Outsourcing capital-heavy operations frees up cash to fund the patents, brands, and creative talent that dictate pricing power. For retail investors, you have to look past traditional accounting metrics. To find true value, you must recognize the hidden balance sheets of IP-heavy compounders who expense their greatest assets. For the workforce, acknowledging the wage premium is critical. The financial upside belongs to those who upskill into software development, engineering, or legal frameworks to participate in this wealth creation. The data is definitive. Modern wealth is no longer constrained by what can be pulled from the ground or manufactured. It is constrained solely by human imagination. If you like such content, then like, share, and subscribe to the MoneyWise Dollar channel. What's your experience with this? Are you working in an IP-heavy industry? Or do you feel traditional physical assets are still safer? Let us know in the comments below.